Well, good morning, everyone. I want to welcome you to today's Building Blocks for Success workshop, the latest in our workshop series that lasts from the fall through the early spring. My name is Brian Hendricks. I'm the Deputy Director of IDOT's Office of Business and Workforce Diversity, and just want to welcome you here today for our workshop on strategies for maintaining good financial health. And presenting our workshop today are people who are very knowledgeable in this topic. They are the ones who are our supportive services consultants in IDOT districts 4, 5, and 6 for any DBE who needs management assistance or anybody who is not yet a DBE but would like to become one. And I'm speaking, of course, of Synergetic Solutions and Melissa Hamilton and Manny Michelson, who are here today. Grateful for them both. Melissa has been, I always call her the VIP. She's been very instrumental in everything we do, from the conference to workshops to getting people certified to getting their work categories expanded to giving them the knowledge they need to succeed and thrive. We're just grateful for her and her team. And Melissa, again, thanks for being here. And the floor is yours.
Well, thank you, Brian. As always, I appreciate your warm and wonderful introduction, and it's an honor to be on the contract serving the DBE firms and assisting with supportive services in any way that we can. I too was a startup company at one time and needed to complete my DBE application, so I understand some of the challenges and struggles in accomplishing that. So it's so great to be able to be on the other side where I can help support companies and businesses with navigating the complex environment that we sometimes work in. So it is an honor to be here. We are excited about our workshop topic today. I have Manny Michelson, or Emmanuel Michelson, he goes by Manny, who's the CEO of TPH Strategies. He was recently brought on as one of our sub-consultants for supportive services. He is an enrolled agent, so he's very familiar with the IRS and tax law, and he will be presenting today to help ensure that we all have a wonderful business health, that our financials within our business is helpful. Some of this information may be high level, and the key points or key takeaways from this is to help open dialogue with the professionals that you are working with to ensure that you have, at least some tools to be able to ask questions to ensure that you are getting what you need out of your business, that your business is becoming profitable. So he will go through quite a few things. Feel free to ensure that you ask us questions. Just a couple of our logistic items for the workshop. Keep your video off. That'll help with our speed. And then mute yourself. But if you do have a question, you can either enter them in the Q&A or the chat. We'll be watching that and taking time to pause throughout to answer any questions. So please feel free to do so. If you don't want to ask your question publicly, you can send it either direct message. Actually, send it direct message to myself. And then I'll pause and make sure that Manny covers those questions for you as well. We will be recording this workshop, so that's another reason if you don't want to submit your question publicly, you can send it privately and we'll be sure to cover it. After the workshop is over, we will follow up with a copy of the presentation, a link to the recording so you can watch it again and slow it down if you need to, along with some additional helpful resources that will be helpful for your business. And then at the very end, we will also have a survey that we please and beg that you complete. It helps us to make sure that we are providing good content and we are able to improve as we are working through our content here. So with that, I'm going to turn it over to Manny. We've already, well, I guess I got one more slide. We've covered the introductions and the logistics. So now we're going to turn it over to Manny to do the strategies for maintaining good financial health. And then we'll open up for Q&A, cover some of the supportive services and resources that we have available to you, along with the workshops and events in our TCTR conference, and then the closing remarks and evaluations. So thank you again. Oh, one more slide. Okay, I forgot I had another one. Sorry, guys. Also, just a disclaimer that this presentation is for informational purposes only. It's not intended to provide any accounting, legal, tax, or financial or professional advice. It does not consider your individual and your company's circumstances or needs. So before acting on any of the information in this presentation, please ensure you're consulting a tax professional, an attorney, or professional to analyze and address your specific needs. Okay, now I'm going to turn it over to Manny.
Thank you for that introduction, Melissa. Good morning, everyone, and welcome to Strategies for Maintaining Good Financial Health. So the objective of today's presentation is to equip you all with practical strategies to understand, analyze, and manage your financial health as it pertains to your business, which in turn should lead to better risk assessment and informed decision making. So I'll be breaking down this presentation into 3 sections, starting with understanding your financial picture, then transitioning over to analyzing financial risk, and then closing it out with strategies for maintaining your financial health. So let's actually kick things off with some small business statistics. So according to the U.S. Small Business Administration, small businesses make up 99.9% of all U.S. firms. And that number is comprised of 33.3 million businesses nationwide. That's a massive number, and that alone should just show you just how important small businesses are to the U.S. economy. Next stat, according to the SBA, the average income for self-employed small business owners is around $51,816 a year. So that number is a bit lower than the national average, but that national average number can be skewed for a variety of reasons. So next, most small businesses are actually self-financed. So almost 4/5 of small business owners were self-financed when they launched. 16% of small businesses used bank funding, and while the other 2 to 6% were financed with loans from friends and family. And then lastly, and this to me is the most shocking, around 18% of small businesses will fail within a year. And so there are many reasons for this, whether that be ineffective marketing, poor leadership and management, various financial hurdles. But a big reason, and one that we'll be addressing in this session, is overall just bad business planning. So in order to truly understand your financial health, you have to understand your financial picture. And you do that by analyzing your key financial statements. So that first financial statement being the balance sheet. We'll be looking at Caterpillar's financial statements, which were made public via their annual report and their 10-K report. So what is a balance sheet and why is it important in the first place? Your balance sheet gives you a snapshot in time. So it gives you a clear picture of your company's financial position at a specific moment. So I want you to think of it like a financial health checkup. It also provides a foundation for analysis. So many key financial ratios and metrics are derived from the balance sheet, helping you assess profitability, liquidity, and solvency. And these are 3 things that we'll be going over later in this session. They also help with investment decisions. So investors typically use your balance sheet to understand a company's assets, liabilities, and equity, which are crucial factors in making investment choices. And then lastly, they help with capital structure. So your balance sheet helps reveal how your company is financed. So debt versus equity, which is very important for assessing long-term sustainability. So as mentioned prior, the balance sheet is made up of 3 components. The first being your assets, your liabilities, and then your equity. And you know your balance sheet is balanced when your assets equal your liabilities plus your equity. So let's take a look at these 3 sections individually. So your asset accounts are typically listed in order of their liquidity, with the most liquid assets being at the top and the least liquid assets being at the bottom. They're also divided into current assets, which can become liquid in a year or less, and long-term or non-current assets, which cannot. So cash and cash equivalents, my apologies, are the most liquid assets. Cash is pretty self-explanatory. It's the cash you have on hand in your account, and cash equivalents are things like treasury bills and CDs. So inventory refers to any goods that are available for sale. They are typically valued at the lowest of the cost or the market price. And then there's property, plant, and equipment, or PP&E. These are long-term assets. So these are physical assets that a company cannot liquidate easily. So these are things like machinery, computers, vehicles, buildings, and land. So next is the liability section. So a liability is any money that a company owes to another party. Liabilities are divided into current assets, and long-term liabilities. Sorry, current liabilities and long-term liabilities. Current liabilities are typically due within 1 year, and they're often listed in order of their due date, whereas long-term liabilities are often due after 1 year. Current liabilities include things like accounts payable, accrued wages, and accrued expenses. Long-term liabilities include things like long-term debt and deferred tax liability. So the last piece of your balance sheet is the shareholder equity, which is the money attributable to the owners of the business or its shareholders. Common and treasury stock are beyond the scope of this session, but the two most common items you'll see here in this section are retained earnings and additional paid-in capital. So overall, the balance sheet helps you assess your risk. With this financial statement, you can quickly see whether you have too much debt on the books. You can see how liquid your assets are, and then you can see how much cash you have on hand to meet certain demands. So your next financial statement is the income statement. So I want you to think of the income statement like a company's report card. It shows how much money the company made, aka revenue, and how much it spent, aka expenses, over a specific period. So like a month, a quarter, or a year. And so by looking at your income statement, you can see whether the company made a profit or a loss. So, and this is very important for the example we'll get into in a bit. I want you to imagine you're running a lemonade stand. Your income statement would track your revenue or money that you made from selling your lemonade, and your expenses, so your cost of lemons, sugar, cups, and signs. And then the income statement would then show you if your lemonade stand made any money or profit, or if you spent more than you earned, which would then be a loss. So why is this financial statement important at all? Well, for starters, it helps with performance tracking. It helps businesses understand how well they're doing financially. It also helps with identifying trends. So by comparing income statements over time, companies can spot trends in sales, cost, and profitability. It also helps with management evaluation. So it can help assess how effectively management is controlling expenses and generating profits. And lastly, it helps with industry comparison. So businesses can compare their income statement to those of their competitors to see exactly how they measure up. So the main takeaway I want you to have from this document is the income statement is really a vital tool for understanding a company's financial performance and making informed business decisions. So the third and final financial statement is called the cash flow statement. And then I'm going to get a little bit into the weeds for this one in particular, but I will zoom back out on the macro level here. So think of the cash flow statement as a company's checkbook. It tracks the cash coming in and going out, showing you where the cash is flowing, as the name suggests. So this helps you understand if a company has enough money to pay its bills, invest in growth, and even to stay afloat. Why is this particular financial statement so important? For starters, it helps evaluate financial health. So just like your personal checkbook, this statement shows if a company has enough cash on hand to cover its expenses and debts. It helps with operational efficiency. So it reveals to you how well the company manages its cash, including collecting payments from customers and paying its suppliers. And then lastly, it helps with investment decisions. So investors typically use the cash flow statement to assess a company's ability to generate cash and to fund future growth. This particular statement is important because it works together with the balance sheet and the income statement to provide a complete picture of a company's entire financial performance. So this statement in itself is broken down into three components. First, that is the cash from operating activity. Next is the cash from investing activity. And then lastly is the cash from financing activity. And let's take a closer look at each of these three sections. So if we dive into this first section of the cash flow statement, this is the cash flow from operating activities, and this is where I really get into the weeds here. So this section is like the engine of your business. It's going to show you how much cash is being generated from your core operations, the day-to-day activities, or the day-to-day activities of selling your products or services. So think of it this way. It's the cash flow that keeps the lights on and allows you to pay your employees. Here are some of the key components that you'll find in this section. So for cash inflows, you'll see receipts from customers, and this is typically the cash you receive from selling your goods or services, and this is the lifeline of your business. Any interest received, so if you have any investments or savings, the interest earned will show up on this in this section. And then any other income from operations. So this can include things like any rent received, any royalties, or any licensing fees. So then you have your cash outflows. So this is payment to suppliers. So that would include the cash you paid for inventory, any raw materials, and any other supplies needed for your operations. Salaries and wages. So that obviously that's the cash you will pay to your employees. Rent and utilities, any interest paid. So if you have any business loan, the interest payments will be recorded in this section. And then taxes and then other operating expenses. So like insurance, advertising expenses, professional fees, those sorts of things. Overall, by analyzing this section, you get a clear picture of how much cash your business is generating from its core operations. This is extremely crucial for understanding your financial health and making informed decisions about things like reinvesting in your business, paying down your debts, or just redistributing your profits. Now let's shift gears and explore the next section of the cash flow statement, that being the cash flow from investing activities. This section focuses on the long-term investments that your business makes. So things that are going to help you grow and generate revenue down the road. So think of this section like planting seeds for the future of your business. And so things you will typically see in this particular section for cash outflows are the purchase of any fixed assets. So this includes any investments in PP&E or property, plant, and equipment. If you buy any a new building, any machinery, vehicles, computer equipment, computer software, this is where the assets are that kind of help you operate and expand your business. The second cash outflow would be any investments in other companies. So if you acquire any ownership stake in another company or purchase securities like stocks and bonds, the cash outflow would be recorded here. And then you have your cash inflows. So those would pertain to three things. One is the sale of any fixed asset. So if you sell any of your existing property, plant, or equipment, that cash inflow would be recorded here. Any proceeds from the sale of investments. So if you sell your investments in other companies or securities, that cash inflow would be recorded here. And then any principal received on loans to others. So if you lent money to a vendor or a customer, those principal repayments would be recorded here. So overall, by analyzing this section, you can really see how your business is investing in its future growth. And then you can ask yourself questions like, are you acquiring new assets to expand your operations? Are you making any strategic investments in other companies? So overall, this section provides valuable insight into your long-term financial strategy. So finally, let's turn our attention to the last section here, which is cash flow from financing activities. And this section deals with how your business raises capital to fund its operations and how it repays its investors or its lenders. So think of this section like managing the sources of fuel that keep your business running. And so the typical things that you will find in here for cash inflows, you have proceeds from issuing any stock. So if your business is a corporation and you issue any new shares of stock to any investors or shareholders, the cash you receive would be recorded here. And then any proceeds from borrowing. So this includes any cash you receive from loans, lines of credit, or any other forms of debt or financing. And then in terms of cash outflows, you will see your repurchase of any stock. So if your company buys back its own shares from investors, the cash outflows would be recorded here. Any repayment of debt principal. So that's any cash payments that you make to reduce the principal amount of any of your loans. Remember that your interest payments are typically recorded in the operating section, but the cash payments you made to reduce that principal will be recorded here. And then lastly, your dividend payments. So if your company distributes any profits to its shareholders in form of dividends, the cash outflow is recorded here. So overall, by analyzing this particular section, you can understand how your business is financed and how it manages its obligations to its investors and its lenders. And then you can ask yourself questions like, are you relying more on debt or equity financing? Or are you paying dividends or reinvesting profits back into the business? This section really provides valuable insight into your overall financial strategies. Okay, so sorry, I think I did want to add one more point to this to the end point here. So overall, your cash flow statement with its three distinct sections gives you a dynamic view of your business's cash movements. So like it's like a movie of your cash. So it's showing you where it's coming from, where it's going, how effectively how effectively you're managing it. And by understanding your cash flow statement, you do gain a deeper understanding of your financial strength and your ability to meet your obligations, as well as your potential for future growth. Overall, it's a very powerful tool for making informed decisions and ensuring the long-term success of your business. So now that you've been introduced to those
Sorry.
two, sorry,
We
go
have
ahead.
one question. What if a shareholder receives money throughout the year? Where is that reported?
Payments to shareholders, is that in terms of a salary or in terms of distributions?
Go ahead and explain both, please.
So typically your salaries would be an expense. So you would see that on your income statement, since you would be paying out those salaries. You would also see that uh, in the third section of the cash flow statement. If you're paying any distributions, which I won't touch on too deeply here, but if you're paying any distributions, those will be on your balance sheet.
Thank you.
No problem. Okay, so now that we've gone over your three financial statements, I actually want to just look at a real world example, or at least a fictitious example here, with the tale of two lemonade stands. So we're going to be looking at two businesses here. The first is Manny's Custom Lemonade. A couple of business facts here. And before I get started, I do want to say when you are looking back on this recording, I would refer back to this slide because I will be building out really simplistic financial statements and going over ratios so you can kind of see how all that is derived, and it kind of starts right here. So a couple of business facts about Manny's Custom Lemonade. He has about $1,000 in cash. He built that really nice lemonade stand and it cost about $1,000. He did secure a pretty sizable $2,600 SBA loan. If you can see, he has 2 gallons of lemonade there, and the pink one is not his recipe. He actually purchased that recipe from the previous owner of a lemonade stand, so that for $1,000, and that is considered goodwill. And then he has about $200 in inventory and 6 years of experience. He is the only lemonade stand in town. So let's actually use some of the information that we just learned and kind of see how we would build out a balance sheet and an income statement for Manny's Custom Lemonade. So right here, as you can see, he has total assets of about $4,600. That includes the $1,000 in cash, the $200 of inventory, the $1,000 for the lemonade stand, which is an asset of his, that $1,000 of goodwill that he did purchase, that recipe that is an asset that he now owns, and then he has various equipment in the tune of $1,400. So that gets his total assets down to $4,600. So he doesn't have any accounts payables or any other liabilities other than that short-term SBA loan in the amount of $2,600. And he did put about an additional $1,500 of his own money, so his owner's equity or owner's capital, sorry. That's where that $1,500 is. And as I said prior, he was established for a couple of years, so he did have retained earnings of $500. So that total up, that 2,600 and that 2,000 shows your total liabilities and equities of 4,600. So if you remember when we were talking about the balance sheet, your assets have to equal your liabilities plus your equity. So in this case, whoever did create Manny's balance sheet did it correctly, and it does balance. So next is his income statement. So he made about $10,000 selling lemonade. He must have really good, that recipe must be really good. He is, buying using that proprietary recipe. So he's buying some really expensive lemons and sugar and some cane sugar, and then spending rather limited expenses on other items such as cups, ice, advertising, water, etc. So his total expenses total up to $5,208. And you take your income and you minus out your expenses, and that's how we get Manny's profit of $4,792. So that right there is how you would construct a balance sheet, a simplistic balance sheet, and a simplistic income statement. But let's look at another example. So this is Sibling Squeeze Lemonade. Remember the tale of two lemonade stands. They are in competition with each other. They have about $500 in cash. They built their stand for $500 as well, and you can tell by the quality of that wood. They have $1,000 outstanding loan from their parents. Really gracious of them. They put $500 in this, so self-financed. They have about $1,000 in inventory, and this is their first year in business. So as you can see, their cash right there is about $500. They have $500 of equipment. They did build this lemonade stand valued at $500. That is an asset. And then they have other inventory items totaling $2,500. So then if you go over to their liabilities, they don't have any accounts payables, but they do have that loan from their parents in the tune of $1,000. Before I move forward, I cannot be an honest man without saying there is a small error on this chart. Remember I said that Sibling Squeeze Lemonade is in their first year of business. And if you are in your first year of business, you would not have any retained earnings. That technically would be zero. But I just want to put that in there for the sake of this example, so everything balanced out. So they did put in $500. That's their owner's capital. And for the sake of the example, they have $1,000 in retained earnings, bringing their total equity to $1,500. And again, whoever prepared their balance sheet also did a good job because their assets does equal their liabilities plus their equity. So let's look at their income statement. They didn't do as good as Manny, but they did sell about $5,000 worth of lemonade. We see more traditional expenses here: $500 on lemons, $350 on sugar. They're obviously not buying any cane sugar. $100 on plastic cups and those sort of things. So their total expenses total up to about $2,100, leaving them in their first year of business, which is pretty impressive, with a profit of $2,900. Okay, so now that we've explored the key financial statements, looked at two examples. Let's actually talk about how you can extract even more meaning from a lot of those numbers. So this is where financial ratios come in. So think of financial ratios as your financial detectives. So they help you uncover hidden clues and insights about your business's performance. So what even are financial ratios? In simple terms, ratios are just relationships between different numbers on your financial statements. They provide context and help you understand how those numbers relate to each other. For example, instead of looking at your total debt, a ratio might tell you how much debt you have compared to your equity. Okay, but what's the purpose? Financial ratios can serve several key purposes. For one, they help assess profitability. They can tell you how effectively you're generating profits from your sales and assets. Second, they help measure liquidity. So they can reveal whether you have enough cash on hand to meet your short-term obligations. Third, they can help evaluate solvency. So they can help you assess your long-term financial stability and your ability to manage debt. And then lastly, they can help track efficiency. So ratios can show you how effectively you're using your assets and resources to generate revenue. So your next question probably is, well, what are the benefits of using these ratios? Well, using financial ratios can help provide numerous benefits to your business. For starters, they're easy to calculate and understand. So most ratios do involve simple calculations that you can do with pretty basic math skills. They also provide valuable insights. So they help offer a deeper understanding of your financial health and financial performance. They can help you identify strengths and weaknesses. So they can help highlight areas where your business is excelling and areas that your business might need some improvement. And they can help track progress over time. So by monitoring your ratios over time, you can see if your strategies are actually working and make any adjustments as needed. So they also support informed overall decision making. So these ratios provide valuable data to support strategic decisions about pricing, expenses, investments, among other things. So in the next few slides, we'll actually dive into some of the most important ratios for small businesses, how we can actually use them to gain valuable insight to make those better informed decisions. So just like athletes track their performance with statistics, businesses can use financial ratios to measure their financial health. And then here are some key ratios you should be monitoring. So first, we're going to go over two profitability ratios. That first being your gross profit margin ratio. So this ratio shows you just how much profit you make on each dollar of sales after deducting the direct cost of producing your goods or services. So the formula here is revenue minus cost of goods sold divided by revenue. So let's say you sell a product for $100 and it costs you $60 to make, your gross profit margin is 40%. So that $40 in profit, the 100 minus 60, divided by the $100 in revenue. Next is your net profit margin. So this ratio shows how much profit you make on each dollar of sales after deducting all expenses, including overhead and taxes. And so the formula here is net income or profit divided by revenue. So a good example would be if your business has $100,000 in revenue and $20,000 in net income, your net profit margin will be 20%. So the next key ratio is liquidity ratios, with the first being the current ratio. So your current ratio measures your ability to pay your short-term liabilities with your current assets. It tells you if you have enough cash on hand to cover your immediate bills. And the formula here is current assets divided by current liabilities. So for example, if you have $50,000 in current assets and $25,000 in current liabilities, your current ratio would be 2 to 1. So that means you have twice as many assets as you have liabilities. The next ratio would be your quick ratio, and this ratio is similar to the current ratio, but it excludes inventory from your current assets. This provides a little bit more of a conservative measure of your liquidity. So the formula here being current assets minus inventory minus any prepaid expenses divided by current liabilities. So next is your solvency ratios. So the first one being your debt to equity ratio. So this ratio shows how much debt your business has compared to its equity. It indicates how much your business is financed by debt versus equity or its own owner investment. And the formula for that is total liabilities divided by shareholder equity. And then lastly is your debt to asset ratio. So this ratio shows how much of your business assets are financed by debt. It provides another perspective on your company's leverage and financial risk. And then that ratio, that formula there is total debt or short-term plus long-term debt, total debt divided by your total assets. So overall, by monitoring these three key ratios, you can gain valuable insights into your business's performance and identify areas for improvement. We'll actually explore how to interpret these ratios and use them for decision making in the next few slides. Okay, so let's take a look at some of these ratios and metrics and what they actually mean for our two lemonade stands. So let's actually get these things interpreted. So let's start with Manny's custom lemonade. His profitability ratio, we use the net profit margin, and it is 0.48 or 48%. His for the liquidity, we use the current ratio, and his is at 1.77. For the solvency, we use debt to equity, and his is at 1.3. And again, when you're reviewing these slides, I would suggest try to use those formulas and try to use that income and balance sheet that was created for these two lemonade stands, and see if you can also arrive at these calculations. But we will be deciphering what these numbers actually mean in the next few slides. So for the sibling squeeze lemonade, for their profitability, since we're comparing the two businesses, we use the same ratios here. So we also use the net profit margin, and theirs is 0.58 or 58%. For their liquidity, using the current ratio, it's at 2.5. And for their solvency ratio, we did use debt to equity, and that was 0.67 or 67%. Okay, so let's see who actually is performing better objectively, just looking at these ratios and metrics. So what we're going to do right now is essentially just turn insight into action. We're looking at profitability first. So Manny's Lemonade Stand had a 0.48 or 48% profit margin. So that would indicate to him that he earns 48 cents in profits for every dollar he collects. Not bad. For the siblings, on the other hand, their ratio was 0.58 or 58% profit margin, which indicates that they earned 58 cents in profits for every dollar they collect. So I would say, if we're just looking at this and comparing apples to apples, even though this is a lemonade stand, I would say that the siblings lemonade stand is performing better from a profitability standpoint. So let's take a look at liquidity. So Manny does have enough financial resources to remain solvent in the short term based off his ratio, whereas the siblings liquidity ratio wasn't too high, but it could indicate that the siblings aren't using their assets efficiently. And I'm just going to go back a couple of slides here if you guys don't mind. So we looked at their current ratio. So Manny's current ratio is 1.77, and the siblings' current ratio is 2.5. When your current ratio is above 1, that is a positive sign. Anytime it starts getting above, closer to 3 or above 3, that kind of just shows that you're not really effectively using those resources properly, if that makes sense. So let's go back here. And in terms of liquidity, it seems like Manny's Lemonade Stand is using their resources a little bit more effectively. And if something were to happen and needed to pay off the SBA loan or any other loans, they do have the adequate financial resources to do so. So lastly, let's look at solvency. Manny has about $1.30 of debt for every dollar of equity. Whereas the siblings only have about 67 cents of debt for every dollar of equity. Obviously, the siblings kind of pull through on this one again. So again, we're comparing lemonade stand to lemonade stand, simply unbiased. Looking at the numbers here, I would say, based off the data, that the siblings lemonade stand is performing better when we're using those financial ratios and metrics to decipher that. Okay, here's our first question break. Does anyone have any questions so far?
Nope, we're all good.
Okay. So we've talked a lot about the types of financial risks to look out for, but what are the actual techniques that you would use? Sorry about that. I think I spoke too fast. Now we're actually going to be talking about analyzing the types of financial risk. So first we looked at the data, we looked at the financial statements, we looked at how to read and interpret those. Now let's actually talk about how to use those to analyze financial risk. So the first risk we would be looking at, and there will be 4 of these, is credit risk. So what is credit risk? So this is the risk that customers or clients won't actually pay their invoices on time or at all. And so this can obviously disrupt your cash flow and make it hard to meet your own financial obligations. So an example of this type of risk would be if a contractor were to complete a project, but the client delays payment or disputes the invoice, this leading to a cash shortage. So this is obviously a pretty important financial risk. How do you mitigate this, right? For starters, and obviously this is one of the most obvious ones, you can thoroughly vet your clients before you extend any credit or before you even do the job. You can set clear payment terms, so send your invoices timely or request a non-refundable deposit before work even starts. And then lastly, you can also offer any incentives for early payment, such as any discounts or things like that. So the second type of financial risk would be the market risk. So what this risk is that any economic conditions, industry trends, or competitor actions will have a negative impact on your business. So an example of this, which is very common right now, is a rise in material cost or a new competitor entering the market that could squeeze your profit margins. So in order to mitigate this particular risk, you can stay informed on industry trends and economic forecasts. So just watching the news, having a good understanding of the supply chain and then what's going on in the market. You can diversify your customer base and your product or service offering. So if your business is completely contingent on one type of product or service, that business is obviously going to have a higher risk failure if there's any type of changes in the market or in your industry, as opposed to a business that has a little bit more of a diversified product or service offering. And then lastly, you want to maintain competitive pricing and always try to explore new markets. So the next type of financial risk are operational risk. And so this is the risk of any loss due to any internal factors like inefficient processes, human error, or fraud. An example of this would be a mistake in the payroll processing system or theft of equipment that could lead to any financial losses. You can mitigate this particular risk by implementing strong internal controls and processes, maintaining adequate insurance coverages, which is very important, and we'll briefly touch on that later, and then invest in employee training and development. Human error will always happen, even as we start using AI in our businesses. So we really want to make sure that our employees are trained and we're putting the money and resources into making sure that they are also just as knowledgeable as us. And so this last financial risk is a compliance risk. So this is the risk of facing any penalties or any legal issues due to failure to comply with laws, regulations, or any industry standards. So an example of this, a scary example of this, would be incorrectly filing your taxes or violating any safety regulations, which could lead to fines or worse, legal action. So the way to mitigate this would be to seek financial advice from your lawyers or your accountants, maintain accurate records and documentation, and then overall just stay informed about relevant laws and regulations. Okay, so now that we've talked about the types of financial risk to look out for, what actual techniques should you be using? So the first risk assessment tool in your disposal is something called a SWOT analysis. So a SWOT analysis is a very powerful tool that helps you take a 360 degree view of your business. So it's like a compass guiding you towards goals by identifying your internal strengths and weaknesses, as well as external opportunities and threats. So what does SWOT even stand for? The first is our strengths. So this is any internal factors that give your business an advantage. So having a strong, experienced team, a strong brand reputation, efficient operations, and unique product and services would be an example of a business's strengths. Next are weaknesses. So these are any internal factors that put your business at a disadvantage. So an example of this would be a lack of funding or lack of capital, having outdated technology, having high employee turnover, or just a limited marketing. Next are opportunities. So that's the O. So these are external factors that could benefit your business. So let's say a growing market demand, new technologies hitting the market, favorable government policies, or any partnerships. And then lastly are threats. Again, these are external factors. So these specific factors can actually harm your business. So an example of these would be any economic downturn, like we saw with COVID, any increased competition, changing of regulations, or supply chain disruptions. So how can a SWOT analysis actually help your business? Well, that comes on 5 fronts actually. The first is strategic planning. So you can use a SWOT analysis to help you with your strategic planning because it helps provide a more clear understanding of your current business situation, which enables you to develop more efficient and effective strategies. The second is competitive advantage. My apologies. So this helps you identify and leverage your strengths to outperform competitors. The third is problem solving. So using a SWOT can help you highlight any weaknesses that need to be addressed to improve performance. The fourth is risk management. So the SWOT can help you identify those potential threats and allow you to develop mitigation strategies, which we're going to touch on here shortly. And then lastly, the SWOT analysis overall can help you with decision making. So this sort of assessment technique provides a framework for making informed decisions about investments, expansions, and then overall just any key initiatives that you want to have in your business. So we've talked about understanding your strengths and weaknesses with the SWOT analysis. Let's take a step further and explore the what ifs of your business. So this is where scenario planning actually comes in. So I want you to think of scenario planning as creating a choose your own adventure for your business. So you'll explore different possible futures and you'll think about how you would respond to unexpected events or changes. Why is something like this important? Well, for one, the future is obviously very uncertain. Let's face it, we can't predict everything that will happen, but scenario planning can help you prepare for a range of possibilities so you're not caught off guard. Two, it helps with better decision making. It encourages discussion and collaboration among your team members, leading to a shared understanding of potential challenges and opportunities. It helps with increased flexibility. So scenario planning can help you develop flexible strategies that can be adapted to different situations, and it just helps overall reduce your risk. So by identifying potential problems in advance, you can take steps to mitigate their impact. So how does a scenario plan actually even work? Well, there's actually 5 key steps to this. So the first is you want to identify any key uncertainties. So these are like so you should be asking yourself, what are the major factors that could affect your business? Economic conditions, competition, regulations, is it capital? So these are obviously going to be unique to your specific business. The second step is to actually develop scenarios. So you want to create a few plausible scenarios, including best case, worst case, and most likely case, again, tailored to your specific business. The third step would be analyzing the impact. So for each scenario, try to consider how it would impact your business. So how it would impact sales, how it would impact cost, operations, client-facing activities, and those sorts of things. The fourth step would be developing responses. So you want to create action plans outlining how you would respond to each of those specific scenarios. And then lastly, and this to me is the most important step, is to monitor and adapt. You need to continuously monitor your situations and adjust your strategies as needed. Your scenario planning, in my opinion, should be something that's reviewed annually. So just to give you another example before we transition over, let's say you're a contractor. One scenario you might consider is a sudden increase in material cost. So how would that impact your project bids and profitability? And what steps would you actually take to mitigate that impact? So by thinking through these scenarios in advance, you'll actually be better prepared to navigate the ups and downs of running a business. Okay, so now let's dive a little bit deeper into some specific factors that can impact your business, and this is where a sensitivity analysis actually comes in. So think of a sensitivity analysis like running experiments for your business. You'll tweak different variables like cost, sales, interest rates, prices, just to see how those specific changes can affect your overall results. So why is this particular risk assessment technique very important? For starters, it helps you identify any key drivers. So sensitivity analysis can help you pinpoint which factors have the biggest impact on your bottom line. Is it your pricing strategy? Is it your marketing spend? And so knowing these sort of things will allow you to focus your efforts like where they matter the most. It's also important because it helps improve forecasting. So by considering a range of possibilities, you can create a little bit more accurate financial forecast and be better prepared for any unexpected changes. They also help support decision making. So it can help you assess any potential risk and rewards for various decisions that you make. And so you can ask yourself questions like, should you invest in any new equipment, or should you expand into a new market? And then your sensitivity analysis can actually help you provide some valuable insights to those decisions. It also helps enhance risk management. So, by understanding how sensitive your business is to various factors, you can develop effective risk mitigation strategies internally. And then lastly, and I would say very importantly, it increases your overall confidence. So sensitivity analysis give you a greater confidence in your plans by testing their resilience to change. We all want to, raise our prices or implement certain things, but actually using a sensitivity analysis will show you how making those decisions will have an impact on your actual business using very specific data. So how does it even work? So for starters, you want to identify your key variables. So you want to start by pinpointing the factors that have the biggest impact on your business. So that might include things like sales volume, price per unit, material cost, or interest rates. You then want to create a baseline scenario. So you want to establish a set of assumptions for your analysis. So think of this as your starting point. In fact, it is your starting point. It represents your expected sales, expected costs, and expected profits. And then from this baseline, everything then gets built out. So next you want to vary the inputs. So you change one variable at a time. So for example, you might want to increase or decrease your sales volume by 10%, 20%, or more. Raise your prices by 5%, 10%, 15%. But you want to do that one at a time, again, starting from that base case to see what happens. Then you want to analyze the results. So you want to observe how these changes in the input variables actually affect your outputs. So how does changing your sales volume, how does increasing or decreasing your prices actually impact profit and cash flow? And then lastly, as the business owner, it's going to help you draw conclusions. So you want to identify which variables have the biggest impact, and then how sensitive your results are to changes in those variables. So if you use sensitivity analysis and you see that, hey, if I raise my prices 10%, there's a chance I lose let's say I raise my prices 10%, but I lose 5% of my customer base, but my profits stay the same, then maybe that's a decision that you might want to make. So just another example off the top of my head here. So let's say you're running a landscaping business as an example. You could actually use this sensitivity analysis to see how changes in fuel cost might affect your profitability. So by varying the fuel price and analyzing the impact of your overall cost and profits, you can make more informed decisions about pricing your services and managing your expenses. So I would say overall, the sensitivity analysis is a very powerful tool for understanding those key drivers of your business, making informed decisions, and navigating uncertainty. So this is our second break for questions. Are there any questions?
Not at this time.
Okay, I'll actually be wrapping up here shortly. So I thank you all. Okay, so we've covered a lot of ground today, from understanding your financial statements to assessing risk and looking at different tools to assess those risks. Now let's actually talk about putting it all together and building a strong financial foundation for your business. So here are the three key strategies to keep your finances in tip-top shape. So the first thing is the budgeting and forecasting. So we're going to talk about the what, the why, and the how. The what? A budget is like a roadmap for your finances. It outlines your expected income and expenses over a specific period, which will then help you track your spending and then stay on track. Forecasting takes that a step further, projecting your financial performance into the future. Okay, but what's the why? Budgeting helps you control your cost. So allocate resources effectively and make overall informed decisions about investments and growth. Forecasting helps you anticipate any potential changes and opportunities so you can be proactive rather than reactive. And then the how. You want to start a budget by tracking your income and expenses. So then you would create a budget that aligns more with your business goals. You want to make sure you regularly review your budget and compare it to your actual performance so you can see how you're meeting up with your budget versus your actual. When it comes to forecasting, you can use various forecasting tools and techniques that go a little bit outside of the scope of this session here to project your future financial performance. So next is cash flow management. Again, the what, the why, and the how. The what here is so cash flow is the lifeline of your business. It's the movement of cash in and out of your company. Effective cash flow management can help you ensure that you have enough cash on hand to meet those obligations and invest in growth. The why. So poor cash flow can cripple even profitable businesses. So by managing your cash flows effectively, you can actually avoid late payments, take advantage of any upcoming opportunities, and maintain financial stabilities. Okay, and then the how. So you want to monitor your cash flows regularly. Optimize your invoicing and collection processes, negotiate favorable payment terms with suppliers, and consider using cash flow forecasting tools to anticipate any potential shortfalls. And then lastly is inventory management. Again, the what, the why, the how. So if your business deals with any physical goods, inventory management is just 100% crucial to the success of your business. Inventory management involves tracking your inventory levels, ensuring you have enough stock to actually meet demands, and then minimize storage costs. For the why, so effective inventory management can help you avoid any stockouts, reduce waste, and improve your overall cash flows. And then how you really want to use inventory management software or techniques to track your stock levels. You can implement a system for reordering inventory, whether it's using something like Excel and having some conditional formatting in there, or actually buying software, which is an investment. And you want to consider strategies like just-in-time inventory to minimize those storage costs. So overall, by implementing these three strategies, you can build a strong financial foundation for your business, ensuring that you have the resources to grow and thrive. So before I wrap up this presentation here, I do want to just add 2 quick slides about seeking expert advice. So if you want to really level up your financial game, you have to seek expert advice. So obviously, in today's world, you do not have to navigate the financial world alone. Accountants and financial advisors both can be invaluable partners in your businesses. And then we're going to go over a couple of questions that you can ask each of those professionals here. So for your accountants, you can start by asking them, how can I improve my record keeping and financial reporting? As we saw earlier in this presentation, your financial statements are very, very important, but those numbers have to come from somewhere, right? So you want to probably work with your accountant to improve your record keeping, and then making sure things are getting filed timely, and things are getting recorded timely and appropriately. You also want to ask your accountant, what are the tax implications of my business decisions? There's a lot of misinformation out on the internet right now, so you really want to talk to your accountant and say, what are the tax implications of me hiring another employee, buying a vehicle at the end of the year? What does depreciation mean? Can I buy this new equipment? All these things are things that your accountant should be able to answer for you and to help you figure out. Next question is, how can I optimize my cash flow and manage my working capital? So obviously, your accountants, they're looking backwards to see like what you did in that year, what worked and what didn't work. So you can work with your accountant, particularly if they're providing any bookkeeping services for you, to go over your cash flows and kind of eliminate some of that wasteful spending if you really want to increase that profitability. And then lastly, you can ask your accountant to help me develop a budget and to track my financial performance. This is very important. Like I mentioned earlier, having a budget versus actual. So at the end of the year, you can actually see, hey, I budgeted $500 for marketing, but I spent $1,000. Do I need to increase my budget, or was that extra $500 just wasteful spending? These are things that your accountant, your accountant can help you figure out. And then next is your financial advisor. Very different from your accountant. They wear two different hats. Sometimes the services can cross, but they do provide two unique, independent services for you as a business owner. First question you can ask your financial advisor is, what are the best strategies for managing my business debt? Do I need to do any loss harvesting? Do I need to change my investments and maybe pay off my business debts through the interest that I'm earning, or through the dividends and interest that I'm earning in my investments? These are things that your financial advisor can help you with. How can I invest my profits to actually grow my business? So at the end of the year, instead of giving myself a bonus, can I put this into the stock market? How would that actually impact my business? You might want to bring in your accountant to this particular conversation to say, if I do invest my profits to grow my business via the stock market, as this particular example, what are the tax implications of that? So that's something that you could also ask your financial advisor. Third is, like, what are the best insurance options to protect my business? There are a lot of professional liability insurances out there that cover different things, from technology to a client slipping and falling to a client suing you. You want to make sure that you work with your financial advisor to make sure that you're insured optimally for your particular business. And then lastly, can you help me develop a long-term financial plan for my business? I would say this is pretty self-explanatory, but at the same time, you do want to work with your financial advisor to kind of set financial goals for the business. How profitable do you want to be over the years? How much of your profits do you want to reinvest into the business versus reinvesting into yourself? These are things that your financial advisor can help you work with. And that is the last of my presentation today. Are there any other questions?
Manny, you'd mentioned software and systems for budgeting and forecasting and cash flow, et cetera. Do you have any recommendations for any that do everything, kind of the budget and the cash flow management as well as the inventory management?
So I'm pretty simplistic. I like Excel. Excel can do a lot of things. I would suggest partnering with your accountant on that, because you can actually build out sensitivity analysis in Excel as well. So you can have a budget, you can have the budget versus actual. You can actually set certain parameters in Excel to run key analysis on your business. You could also use things like QuickBooks. QuickBooks lets you establish a budget. QuickBooks helps you categorize your transactions and those sorts of things. So I would typically recommend either QuickBooks or Excel, or a combination of both.
Perfect. All right, I'm looking in the chat. I didn't check the Q&A, so if you did put a question in the Q&A, I did not glance at that, but if you do have one, please send your questions over. And Manny, I'm going to have you stop sharing, and I'm going to share my screen. Give me just 1 second to get my presentation up. All right. Hold on, guys. Everything switched on me. You never know what screen it's going to pop on. All right. Let's get back to where we left off. All right, so takeaways. As we mentioned before, this information that's been provided is to help you have thought-provoking ideas, as well as information that you can reach out to your tax professional to discuss further. So it's not intended to provide you with legal or accounting or financial advice. So you do want to make sure you connect with a professional, but we do have these resources available for you for consideration. So going into a few of our other sources with IDOT, IDOT obviously has their Disadvantaged Business Enterprise Program Many of you may or may not be familiar with it. We do have some online video tutorials that go deeper into the services that we're providing, but IDOT's intent is to ensure that there is equity, access, and transparency amongst the department. And by doing so, we're providing services to firms at no cost to the firm to support and help you with your organization, your company, and doing business with IDOT. These services are offered to those that are IDOT DBE certified, or those that are seeking work with IDOT currently or under contract with IDOT. Some of these services, or all of these services, are performed under the Office of Business and Workforce Diversity. Brian Hendricks is the Deputy Director of that, and he was on earlier today sharing information and introducing us and getting us started. So his email is on the slide there if you do need to get in touch or in contact with Brian. Part of the supportive services are broken up into 3 different categories amongst our districts. So you'll see the map over to the right, but we do offer certification assistance. So if you are not certified, or if there is someone that you know that is interested in becoming certified, please look at the area on the map of where they're located. And then on the left, it'll show who is providing that service within their district. So for example, districts 4 through 6, if they're interested in certification, they can contact me. And then Theo is our northern area, and Mark is doing the southern region. And then as it relates to management assistance, we also have 3 different consultants on to support with management services. And then with our technical services, we have Ron Brown with Gonzalez Company, and he manages technical services for the entire district. So what are management and technical services? So as I mentioned before, these services are provided to you complimentary. On the left-hand side, you can see the technical services that are available to you. So if your company is needing assistance with estimating and bidding, equipment and resources, project site inspection, pre-qualification, and more, our technical team can assist there. And then the management team can assist with bookkeeping systems and credit restoration. We also help with cash flow, understanding and making sure you're aware of that, bonding and insurance, business and strategic planning, and marketing as well. So a lot of the things that were covered in the presentation today. If you need help, if you don't have a software, we mentioned QuickBooks, we can help you and teach you how to get your company information entered and submitted into QuickBooks and start managing a lot of those reports and tools that he mentioned during this presentation. And then we have resource centers for you. So across the district, there are 9 resource centers, basically 1 in each district. So 1 in each district of that map that I just showed. And the resource centers that allow you equipment and resources to help conduct business. So there's computer access, internet, there's scanners, copiers, and printers. So if you need to get the IDOT plan with the letting and you need that big printout, you can get that done at one of our resource centers or have that picked up there. And then there's also staff there to support and assist you as well. The use of the resource center is free of charge to those that are doing business with IDOT, and you can find those locations on IDOT's website by visiting idot.illinois.gov. We have compliance officers as well that can support and assist you. They are accountable for helping our EEO and labor compliance laws for the state and federal funded projects. So if you have questions as it pertains to compliance on contracts and ensuring that your company is meeting the compliance, then visit the idot.illinois.gov website as well. On that website, there's a nice little search box in the upper right corner, and you can search contract compliance officer, and the ones located in your district will show up and appear. All right, available programs. So once you are IDOT DBE certified, we have a DBE reimbursement program that you are eligible for. So there's various categories that you can apply. Reach out to your supportive service consultants if you have any questions. But if you do have membership costs or association costs, training that you are taking part on to expand your business knowledge, to increase your work categories, your website capability statement, and logo designs, you can get reimbursement for these things, in addition to your accounting and bookkeeping software as well. So if you do have accounting with payroll, such as QuickBooks or another software, you can get 50% reimbursement on that qualified expense. There is a maximum amount that you are allotted, and it does vary by category. And it also is contingent on funds being available. So I always encourage companies, if they do want to get TBE reimbursements, please send those in as soon as possible so that you don't end up not being able to get reimbursed due to funds being spent. So the business development program is a program that we have to help support our firms and help you get started. You have to apply for it. Once you are approved in the program, there will be custom training and an evaluation for your business with an analysis given to you to help support you and help you grow in the direction in which your company is looking to excel in that year. So there's usually 15 firms that get accepted. We currently do not have the applications open, but hopefully they will open soon. And once they do, please apply. Mobilization payments are payments that you can receive if you have an IDOT contract, and you basically get a payment 7 days prior to the work starting on the contract if you are a subcontractor. The intent of this mobilization payment was put into place to help subcontractors get started on work. Sometimes you have to get equipment or get your team hired and get that first payroll out. So you have those expenses that you need to pay out, and sometimes the payments can take time to be processed, and you get paid back for the work and the services. So based on the allotted contract amount, there are various percentages that you can get 7 days prior to work, and that does get deducted off of your final payments once the projects are completed. Our HCCTP program is a wonderful program where we partner with local colleges to provide skill set and certification to those interested in the trade industries and life skills. So HCCTP stands for Highway Construction Careers Training Program. We have different training locations throughout the state of Illinois. On the slide, you can see the different types of industry trades and life skills that are eligible for this program. So if you do know anyone who's interested, or if you're looking to hire, this is a great way to find skilled, qualified, and well-trained candidates to join your team. In addition, if you hire a graduate from this program and you're working on IDOT projects, there is opportunities for some reimbursement for hiring those individuals as well. To be qualified, they're looking for eligibility from women, minority groups, and other persons from historically underutilized populations. They must be 18 years or older, have a high school diploma or GED, a valid driver's license, and be able to pass a drug test. So if you know any individuals that meet that criteria that maybe aren't interested in traditional, professional college courses in that direction, but are interested in learning a skilled trade and going to college to do so, this is a great program for that. My favorite part, events and workshops. So we are obviously putting on tons of workshops to educate your company and your firms on various topics. We are always looking to evolve this program. So if you do have ideas for new topics or subject matter content that you would like us to get experts on to help put together additional workshops and events, please let us know when you take the survey at the end. You can add that in the additional comments. But we do host these workshops. We have quite a few remaining in our Building Blocks workshop series for this calendar year. They'll go through the month of March, but you should have registered using that link on the screen. But if you have not, please make sure you follow it. As new content and events are added, you will be notified. So we do want to make sure that we are providing you with great resources to learn, grow, and develop, and make sure you're staying on top of all the best practices and policies and procedure changes that occur throughout the year. And TCTR. So TCTR is today's challenge, tomorrow's reward. This conference is coming up here February 26th and 27th at the Crown Plaza in Springfield. This is IDOT's annual conference where we have networking, workshop breakout sessions, wonderful speakers. This year we have Jackie Joyner-Kersee as the motivational speaker. We will have a keynote speaker on the second day. You get fed a lot of wonderful dishes and meals and food. They're actually at the event today, checking things out and getting things finalized as well, or at the venue. So please make sure that you attend. There's a lot of opportunity to network at the events. We'll have vendor exhibitor stations, free swag bags. So make sure you block out your calendar to attend. If you need to register, you can scan that QR code on the screen. You also can visit the link that's on this screen as well. This will all be provided to you via email. The links will be in the email. The presentation will be in the email. So you'll have everything that you need to register. There is a meet and greet the night before, which is on February 25th. You see that on the screen, but at this time, the limited number of attendees is full. So there are no opportunities to attend at this time, but you can get on a waiting list in case individuals cancel or determine that they're unable to attend. They'll reach back out to you if you would like to come to the event on the 25th. But there will be a lot of great things happening on the 26th and 27th. So don't worry, you are not going to miss out. We have the TCTR recognition is going to happen as well. So there are opportunities for awards. The ones you see on the screen are the last year's categories. And one of our technical consultants, Ron Brown, he's in that screen there. He received an award as well for all of the great work that he does within the agency and this organization as well. The new nominated categories are here on the screen. So there are going to be 5. The Memorial Award and the Prime of Primes is the same. The top 3 listed there were the ones that were revised. So if you do know an ideal firm that should be nominated for this award, they should have either worked or won a contract with IDOT within the last few years. However, if they haven't, but you can make a great justification on why they should be nominated, you can submit that in the form. They're due January 24th and 25th. So please take a minute to think of if there's anyone you would like to nominate. If you do, send that email to brian.d.hendricks@illinois.gov. In the subject line, put 2025 TCTR nomination. In the body of the email, you'll want to include the nominee firm name, which category you are nominating them for, and then the reason for the nomination. And again, that needs to be submitted by January 24th. So please send that in if you have someone. Next workshop coming up is this. It says Tuesday on the slide, but it is actually Thursday because today is Tuesday. So Thursday, January 16th, we will have the Is My Business Worth Selling workshop. So you can take a look at your company and Manny will be sharing what people are looking for when purchasing a company. And if you're not ready yet, at some point you may want to sell your business. So this will be a great time to kind of learn and have that in your mind and information on that so that you can prepare that for when you are ready to sell and not just close the business, get some money out of it from your hard work of building and developing. So our workshop series, we have we're currently in the financing and financial management series. Next, we'll enter into strategies for business success series, and then leveraging the technology and innovation series, which is a new one we included this year. And there'll be some great topics as it relates to the technology. Here is the remaining workshops for January. So as I mentioned, Is My Business Worth Selling? Then we have budgeting, cash flow management, QuickBooks setup for your company, lending, SBA, and Advantage Illinois. So if you're looking for funding, that will be a great one. The individuals who operate from those programs will be presenting and sharing information about accessing funds. And then on the 30th will be overhead rate calculations. Where are all of these webinars found? We have so many, and sometimes you can't attend them all. So we do have a YouTube channel. If you go to youtube.com/@Illinois, spelled out DOT, you will see that there is a playlist for the Illinois Department of Transportation link there. This will take you to the Illinois or to IDOT Supportive Service Consultants playlist. And this is where we house all of our recordings. And we've been doing this for about 2 years now, going on 3. So you can find some of our workshops from the past if you'd like to reference those. I do like watching some workshops through the YouTube channels because I can change the speed and slow them down or speed them up, in addition to take breaks and pause as I need to digest all of the great information that's being shared. So feel free to check out our YouTube channel. I lost my Q&A somewhere in the screen. Let me see if I can find it real quick to see if we have any questions. While I'm looking to see if there are questions, I'm going to go ahead and flip to the next slide. If you can scan that QR code that's on the screen, and then I'll stop sharing here in just a second so I can find my chat. But this is where the survey link is for this particular workshop. I will include it in the email as well. But once you click, it's going to ask which workshop series we are in. Again, we're in the financing and finance management series. And the topic, that's wrong, is managing or maintaining a good financial health. So select that as the topic for today's workshop, and then fill in the survey, and we'll again send that to you in email as well. And then that's the information in contact to the Business of Workforce Diversity if you need that information. So I'm going to stop share here and just check the chat. And I do see a question. So when you are submitting your paperwork for reimbursement, I'm going to put it in the chat. You can also contact supportive services if you have questions. But if you send it to that email address, dot.sbe@illinois.gov, it's the last, it is the last email address on the presentation slides when we send that out. Then you can send that over for reimbursement. And then they'll forward it over to the person that will process the reimbursements. You are welcome. Any other questions? All right. Well, within the next day, I don't know if it'll be today or tomorrow, but we should get the follow-up email out to you all from today's workshop. We appreciate you hanging on and joining today. I know everyone has very busy schedules, so we do value your time and appreciate your attendance. And we are available for any assistance that you may need in the future. So thank you very much for joining.